Let's continue our discussion from the last issue. After the stablecoin bridge was built, the application scenarios of the crypto world were greatly broadened. It is no longer just a paradise for speculators, but has begun to play a role in many real financial scenarios. The most basic and important application of stablecoins is the universal currency and safe haven of the crypto market. On any cryptocurrency exchange, you will see a large number of trading pairs denominated in stablecoins, mainly USDT or USDC, such as the ratio of Bitcoin to USDT, and the ratio of Ethereum to USDT. Stablecoins provide a stable unit of account. Investors can easily buy stablecoins with fiat currency, and then use stablecoins to buy any other cryptocurrency they want to buy. This is much simpler than directly buying thousands of different cryptocurrencies with fiat currency, greatly improving market liquidity and transaction efficiency. When the crypto market plummets, investors can quickly sell their volatile crypto assets, such as Bitcoin, and exchange them for stablecoins with stable value, thereby locking in profits or avoiding greater losses. This is just like when the stock market plummets, investors will sell stocks for cash. Stablecoins are the cash in the crypto world and are important safe haven assets. In the application scenarios of cross-border payments and remittances, stablecoins can be said to be a complete win compared to traditional methods. Cross-border remittances under the traditional financial system are a painful thing. It usually needs to go through multiple intermediary banks, which not only has high fees, the average fee rate may be as high as 7%, but also has a slow speed. A remittance may take 2 to 5 working days to arrive. Stablecoins have completely changed this situation. Based on blockchain technology, a stablecoin transfer can be received almost in real time, no matter where the recipient is in the world. And its handling fee is extremely low, usually less than 1% of the traditional method. Here is a real example. Imagine a Filipino worker working in Europe who wants to send money to his relatives in his hometown. In the past, he needed to go to the bank to remit money, pay high handling fees, and his family had to wait for several days to receive the money. Now, he can exchange his salary for stablecoins and send it directly to his family through a mobile wallet. The family can receive it within a few minutes, and then can exchange it for the local currency at a local exchange point or through a platform that supports stablecoins. The whole process is fast, cheap and transparent. In addition, stablecoins are also very attractive to companies engaged in cross-border trade. They can use stablecoins to pay international suppliers, greatly shorten the capital turnover cycle, and reduce exchange costs and risks. For example, the crypto payment platform BitPay has already provided such services to many companies. Stablecoins are also the blood of decentralized finance, DeFi. It can be said that without stablecoins, there would be no prosperous DeFi ecosystem today. Stablecoins play the role of blood in DeFi, running through various links such as lending, financial management, and trading. On decentralized lending platforms such as Aave and Compound, stablecoins are the most popular assets. Users can deposit their own stablecoins, such as USDC, DAI, and lend them to people who need funds to earn interest. This process is like opening a current savings account at a bank, but the interest is usually much higher than that of a traditional bank. Conversely, you can also pledge your own crypto assets and lend stablecoins to meet your funding needs. On DEXs such as Uniswap, stablecoins are the key to building liquidity. A large number of users will pair their stablecoins with another crypto asset, such as Ethereum ETH, and put them into a liquidity pool to provide trading depth for other traders and earn commission dividends. This makes the transaction slippage on DEX lower and the experience smoother. From trading to payment to complex financial applications, stablecoins are profoundly changing the way value circulates, making financial services more global, efficient, and inclusive. We have a general understanding of several mainstream stablecoins on the market. So what is the evolution direction of stablecoins and the competition between them? Although the stablecoin track has broad prospects, the competition is also extremely fierce. Different types of stablecoins, with their own characteristics, have competed in this competition. We compare these different types of stablecoins from several key dimensions. Fiat collateralized stablecoins, the operating mechanism is like a bank deposit certificate, or casino chips. The source of stability is the fiat currency reserves, cash, treasury bonds, held by centralized institutions. The degree of decentralization is low, and the main risks are custody risks, opaque reserves, and centralized review. The main representative is USDT/USDC. Crypto-collateralized stablecoins, the operating mechanism is like a decentralized digital pawnshop. The source of stability is the excess crypto asset collateral locked by the on-chain smart contract. The degree of decentralization is high, and the main risks are the failure of the algorithm in extreme markets, death spiral, and trust crisis. The main representative is DAI/USDA. Algorithmic stablecoins, the operating mechanism is like an automated central bank. The source of stability is the dynamic adjustment of token supply and demand by smart contracts. The degree of decentralization is high, and the main risks are drastic fluctuations in collateral prices, liquidation risks, and low capital efficiency. The main representative is FRAX. Physical asset collateralized stablecoins, the operating mechanism is like a digital warehouse voucher. The source of stability is physical commodities, such as gold, held by regulated institutions. The degree of decentralization is low, and the main risks are custody risks, physical asset price fluctuations, and audit reliance. The main representative is KXG. Synthetic stablecoin, the operating mechanism is a neutral hedge fund. The source of stability is the hedging combination of spot assets and derivative short positions. The degree of decentralization is medium, and the main risks are funding rate risk, exchange counterparty risk, and liquidity risk. The main representative is USDA. In general, different types of stablecoins are a trade-off between stability, decentralization, and compliance. These three form an impossible triangle relationship. It is impossible to have both and all. If you value stability and compliance the most and are willing to sacrifice a certain degree of decentralization for this, then the fiat collateralized stablecoin is the first choice. This is why USDT and USDC can occupy more than 90% of the market share. If you are a firm believer in decentralization and pursue a permissionless and censorship-resistant financial system, then crypto-collateralized stablecoins are more in line with your philosophy. Algorithmic stablecoins are the boldest exploration of future financial models, but at present, it still has a long way to go before it is mature and reliable. As for the future of stablecoins, it will unfold in the interweaving of innovation, regulation, and integration. From the United States to Europe to Asia, major economies around the world are stepping up the development of regulatory frameworks for stablecoins. The European Union's Markets in Crypto-Assets Regulation, MiCA, has come into effect, which sets clear requirements for the issuance, reserves and operations of stablecoins. It can be foreseen that the regulatory environment will become increasingly stringent in the future, and the era of wild growth is over. For stablecoin projects, compliance will no longer be a plus, but a life and death line. Only those projects that can actively embrace regulation and improve transparency can go further. Stablecoins are making the boundaries between cryptocurrencies and traditional finance increasingly blurred. Payment giant PayPal has launched its own stablecoin PYUSD. Visa and MasterCard are also actively exploring how to use stablecoin networks for settlement. In the future, we will see more and more traditional financial institutions entering this field, and they may issue their own stablecoins or integrate existing stablecoins into their payment and financial services. This integration will bring a huge user base and application scenarios for stablecoins. This is also an important reason why investors in traditional capital markets must understand the cryptocurrency market. Although the market is dominated by giants, innovations are still emerging. The synthetic dollar, represented by USDA, is an example. It attempts to create a new type of stablecoin that can maintain stability and generate income by staking the income of Ethereum and hedging the futures market. Although this new model is also accompanied by new risks, such as market capacity risk and custody risk, it represents the industry's efforts to continuously explore better solutions. Let's take a look at the stablecoin market. According to the forecast of the authoritative institution ARK Invest, by 2030, the global supply of stablecoins may grow from the current approximately $200 billion to $1.4 trillion. If this forecast comes true, stablecoins will become the 13th largest currency in circulation in the world, exceeding the fiat currency supply of Spain and the Netherlands. It will play an increasingly important role in currency substitution, cross-border payments, and corporate salary payments in emerging markets. We talked about the birth of Bitcoin, the era of smart contracts opened by Ethereum, how stablecoins can become a bridge connecting the two worlds, and its wide application in transactions, payments and DeFi. Finally, we explored the competitive landscape and future of different stablecoins. The story of stablecoins is far from over. It is not only the stable anchor for the smooth operation of the crypto market, but also the engine that drives continuous financial innovation. It shows us a possibility, a more open, efficient and inclusive global financial system. In this system, the flow of value is no longer constrained by geographical location and traditional intermediaries. Of course, the road to this future is full of challenges, including technical uncertainty, high market volatility, and most importantly, increasingly stringent global supervision. In the future, the stablecoin market will continue to move forward in the balance between innovation and compliance. For each of us, keeping an open mind to understand and learn may be the best way to seize future opportunities for ourselves in this rapidly changing era. At present, this parallel financial world is intersecting with the real world. All this is just like the evolution of internet technology from nothing to something, and the evolution of users from rare to common. At the moment when the pace of life is accelerating, the revolution brought by cryptocurrency will only be faster. As investors, we must catch up with this train. The above is a little information and personal opinion shared with you today. Thank you for your company. Let us learn and progress together.